And let's talk about buying and some of the mistakes people make, because people put off buying real estate way too long. Sometimes they want to avoid PMI insurance, for example. PMI being private mortgage insurance, which protects the lender from default of the borrower. So let's talk about that for a minute. I've got a scenario here of a $300,000 home purchase. And let's just pretend, Seth, like you've got $20,000 you want to put down, and your counsel has been, you got to put 20%. Well, 20% is $60,000. You don't have 20%. You're not going to have $60,000 for quite a while. So let's take a look at what that $300,000 home is going to do while you're trying to accumulate $60,000. Well, if it appreciates 3.9%, that's $11,000 per year, 11,700 appreciation per year as an average. You've got to save more than that in order to catch up with trying to get to a 20% down payment. So in other words, if you are trying to accumulate 40 more thousand, you have to save $22,000 a year for the next 4 years in order to have that $60,000 down payment. That's crazy. You're not going to be able to do it. So let's take a look at what happens. You borrow you have $20,000 to put down. You borrow $280,000. You've got a 6.7% down payment. That seems really small, but $20,000 seems really big. So they're going to charge you PMI. Now, PMI is based on your credit history. It's based on, primarily on your credit history, your ability to pay back that which you borrow. So you need to build good credit history. Pay off your bills and pay them off on time every month. So PMI costs approximately 0.58 to 1.86% of your mortgage balance every year. 0.58 to 1.86. So let's look at scenario number one. You've got great credit score, and your PMI rate is 0.58. Your cost of PMI insurance is $135 per month. Let's look at the math. $135 a month is $1,620 per year. Now, you've got 3.9% appreciation of what, Seth? The entire amount of the value of the home. So 3.9% appreciation of $300,000 is $11,700 per year appreciation. You've got $1,620 of PMI cost, so you're net positive $10,080. So let's look at your return on equity. Take your $11,700 of appreciation minus your PMI cost. That's $10,080. That's a 50% return on equity per year. Every year. Now, if you could invest in the stock market and get 50% on your money every year, would you do it? Of course.
Probably.
Of course.
Absolutely.
So in this case, you can put $20,000 down, get 50% return on your equity, and live in it. That's a little better than just watching it come on a statement every month from the Schwab. Let's look at scenario number two. Now your credit score is not as good. You're paying 1%. Your monthly cost is $233 now for your PMI. That's $2,796 per year. Your home's still appreciating $11,700, right?
Yeah.
It's still 3.9%. So that's a positive $8,904 above your PMI cost. That's 44% return on your money. And in the worst case scenario where you're paying 1.86% for your PMI cost, $434 a month. It seems outrageous. But you've got $11,700 per year capital appreciation of your home at an average rate. And understand, I'm saying that's average. It may not do it the first year, May not do it the first 2 years, but the third or fourth year, it may appreciate 10 or 12%. So $11,700 appreciation. I just said, you're paying $434 a month for PMI. Seems outrageous, but that's $5,200 a year. You've got a net positive $6,496, or 32% return on your $20,000 down payment on your home. Now, you get to live in the house too. So Uncle Sam's going to help you pay for it. If you can tax deduct your interest expense, if you've got $280,000 of interest expense at 4.5% is what I've done all these calculations. I went to NerdWallet, which you can all go to nerdwallet.com, do these calculations. At 4.5%, your mortgage payment at the highest rate of PMI is $2,100 per month. I've got kids right now up in New Hampshire that are paying $2,000 a month for about a 500 square foot apartment. So is it better to buy even if you don't have 20% down? If you have good credit, get pre-approved, borrow, and buy.
First of all, that is really amazing to hear how simple it is. It's so simple. And knowing that you don't have to put 20% down. I mean, I was told the same exact thing. I was told that exact same thing. Wait until you have 20% and then you can buy. But it's great to hear, just if you are faithful, you have good credit, like you said, and you put that money to it, it's going to work for you.
Absolutely. The biggest issue that people forget is the capital appreciation of your home. Now, you can't spend capital appreciation. We all know that. But your capital appreciation can help you move toward that next home purchase. So in other words, if you buy a $300,000 home today and you're growing and you're saving and you're putting some money aside, and 10 years from now, you're out of that home or ready to move out of that home and you're looking for something different, remember that $300,000 home has gone up in value by about $11,000 per year. That's simple interest. So in 10 years, it's gone up $100,000. We know that it compounds, so it's really going up more than that. But let's just say it's a $400,000 home. Now you've got $120,000 of equity plus any pay down that you've had on your mortgage payments. So let's call it 125 or 130. Now you can do the same thing and get into the home, or a home that's more suitable.
Hey, remember to click the subscribe button right here on the screen. And don't forget to hit the notification bell so you'll be notified when new content is added. And more importantly than anything, you don't want to miss all 3 live hours of Financial Issues every day from 9 to noon. And you can watch it on FISM.tv. That's FISM.tv.